Hey PipBuddies, welcome back to the channel. If you've been watching charts for a while, you've probably noticed something curious about candlesticks. Sometimes they have big, thick bodies. Sometimes they're tiny little things, and sometimes they look like they've sprouted antennae, or fishing lines, sticking out of the top or bottom. These lines are called wicks, or shadows, and they are one of the most underrated clues in technical analysis. So today we're going to be digging into what those wicks really mean, why they form, and how to read them like a pro, because if candlestick bodies are the plot of the story, the wicks are the hidden subtext. And once you learn to read them, you'll understand a lot more about the battle between buyers and sellers. A candlestick's wick is the thin line above or below the candle's body. The upper wick shows the highest price reached during that time period, and the lower wick shows the lowest price. The body, that thick part in the middle, shows where price opened and closed. Think of the wick as the journey the price took before it settled down for the close. If the candle is a photograph of a battle, the body is the final score, but the wicks are the highlights of what happened during the fight. They tell you where price ventured, who tried to take control, and whether that attempt succeeded or failed. Wicks are formed when price moves beyond the open and close, but then gets pushed back. A long wick at the top of a candle means price tried to go higher but was rejected, indicating that sellers overpowered buyers at that level. A long wick at the bottom means price tried to go lower but was rejected, indicating that buyers stepped in and forced the price back up. This is why wicks are so powerful. They show you rejection, indecision, or exhaustion in real time. A candle might close bullish, but if it has a huge wick on the top, it's a warning sign that buyers are running into resistance. Likewise, a bearish candle with a long lower wick can be a clue that sellers are losing steam. Let's say you see a green candle charging upward with a tall upper wick. At first glance, it might seem bullish because the body is green, but that long wick tells you that price went even higher during the candle's life. And then sellers slammed it back down before it could close at the high. This could mean that resistance is strong or that buying momentum is fading. It's a bit like someone trying to dunk a basketball but getting blocked at the last second. They still score some points, but they didn't get the slam they wanted. In trading terms, that wick can sometimes be the early sign of a reversal or at least a pause in the uptrend. Now, imagine a red candle with a longer, lower wick. It might look bearish at first, but that lower wick is telling a different story. Price fell sharply during the candle's life, but then buyers stormed in, lifted it back up, and softened the bearish close. This is often a sign that the market is finding support, or that selling pressure is weakening. It's like a boxer who gets knocked down in the early rounds, but then comes back swinging before the bell. Even if they lose that round, they've shown they can fight back. When you see a candle with a tiny body but long wicks on both ends, that's a classic sign of indecision. Neither buyers nor sellers could take control for too long. The market pushed up, pushed down, and in the end closed right around where it opened. So this is where patterns like doji candles come into play. A doji with long wicks is basically the market saying, I'm not sure which way to go yet. It doesn't guarantee a reversal, but it does mean you should pay attention to what happens next, because indecision often leads to a decisive move. Now, here's where a lot of traders mess up. They see a wick and immediately assume it's a reversal signal. But a wick's meaning depends entirely on context. A long upper wick at a strong resistance level is very different from a long upper wick in the middle of a bullish breakout. You have to combine wick analysis with the bigger picture here. What's the trend? Where are your support and resistance zones? What's the volume doing? A wick on its own is just a clue. A wick combined with other evidence can be a conviction signal. Wicks can help you time entries, exits, and stop loss placements, but if you see repeated long lower wicks forming at a support level, it might be a good sign that buyers are defending that price, and it could be a potential entry point for a long position. If you see multiple long upper wicks hitting the same resistance level, that might be a signal to take profits or look for short opportunities. They can also help with stop placement. If you're going long above a support level that's been marked by long lower wicks, you might want to place your stop just below the lowest wick in that area. That way, you're giving your trade room to breathe while still protecting yourself if the market truly breaks through. Now, one of the biggest mistakes traders make with wicks is reading too much into a single candle. Just because you see one long wick doesn't mean the market will instantly reverse. You need to see patterns and repeated behavior. Another mistake is ignoring the time frame. A wick that looks dramatic on the 1 minute chart might be completely insignificant on the daily chart. Always zoom out to check the bigger picture. A third mistake is treating every wick as equal. Some wicks form because of genuine rejection at key level. Others happen during low liquidity moments, like right before a major news release or during the market open or close. Knowing when and why a wick forms will help you avoid false signals. Wicks aren't just for spotting reversals. They can also confirm trends. In a strong uptrend, you'll often see small lower wicks as buyers quickly step in to defend price. In a strong downtrend, you'll see small upper wicks as sellers quickly push price back down. Watching the behavior of wicks during pullbacks can give you confidence to hold your position or clues that momentum is fading. So there you have it. Wicks are the market's way of showing you the push and pull between buyers and sellers. Long upper wicks warn of resistance and fading momentum. Long lower wicks hint at support and buyer strength. Small bodies with big wicks tell you the market is undecided. But remember, wicks don't work in isolation. You have to read them in the context of trend levels and market conditions. In the next video, we're going to be talking about something every trader needs to master: the difference between ranges and trends and how to spot which one you're in before you make a move. Because trading a range like it's a trend or a trend like it's a range can be a costly mistake. If you learned something new today, do give this video a like, drop a comment down below with the most telling wick pattern you've ever spotted, and subscribe so you don't miss what's next. Until then, keep studying those candles, because the bodies tell you what happened, but the wicks tell you why.